much for joining us tonight. My name is Barry Erickson, and I'm Community Engagement Coordinator here at Wheaton Public Library. Tonight, we are proud to bring you this program on financial management as part of our ACES series. Hopefully, you're getting familiar with that ACES acronym. ACES stands for Aging and Caregiving Engagement and Support. This program series provides a consolidated source of reliable local information and engaging programming for our community's older adults. Tonight, Greg Kurinec, a certified financial planner, is here for us. He is with the Society for Financial Awareness. So thanks so much for joining us tonight, Greg. I'm going to turn the screen over to you.
Thank you, Barry. Thank you for having me this evening, and thank you for everybody for attending. As Barry said, my name is Greg Kurinec, and I am with SOFA, the Society for Financial Awareness. And what SOFA is they're a 501c3 corporation whose mission it is to spread financial literacy amongst the community. So we go to different groups, organizations, places of worship, and do presentations on financial literacy. And as you'll see this evening, these are all educational in nature. There's no products being sold or anything like that. So it's just a way to kind of give back to the community. So I've been with SOFA for going on almost 5 years now at this point, and again, it's almost become a bit of a passion of mine to do these financial literacy programs. So I want to commend you guys first and foremost for coming out and taking advantage of this free presentation that the Wheaton Library is putting on this evening. I was giving the same presentation out in Naperville last evening, and there was a lot of people that had to brave the storm. So this is a little bit easier where we just have to turn on our screen and go from there. So thank you, everybody, for attending. As Barry mentioned, I am a certified financial planner. I graduated from Purdue University with a degree in financial planning and counseling. So I work exclusively with people at or near retirement. So I help them with their investment advising, estate planning, risk management, and tax planning needs. And we're going to touch a little bit on each of those here this evening. And the name of the presentation, Financial Intelligence, Pulling It All Together, is just a way for us to kind of take a look at where we are in the retirement landscape. I'm going to give you some key dates to kind of focus on as you progress through your retirement planning, and some things to keep in mind. We'll touch on investments and different investment products. We'll also talk about taxation and how we can go ahead and, since we've saved all this money in retirement through 401ks and IRAs and Roth IRAs, how do we, once we approach retirement, start to use those savings as an income? So we'll talk about some of those strategies as well. But as Barry said, please ask questions as we go along. I feel it encourages a more fruitful discussion. As she said, use the Q&A box on the top of your screen if you're watching. And then at the end, I'll pause throughout the presentation to answer those. And then at the end, I'll also open the floor to anybody that might be brave enough to ask any more questions and kind of stick around for that. So with that being said, we can go ahead and get started with our presentation this evening. And one of the things that, we like to stress when we're talking about our retirement planning is the fear of running out of money. And this fear is even larger than the fear of death, okay? And I'm still trying to get my arms around that. But really, people are so afraid when it comes to retirement and pulling the retirement ripcord, so to speak, or taking that giant leap into retirement, because we're so used to having these paychecks for so long, these guaranteed paychecks from work, that we don't know how it's actually going to work out. So part of what I'm going to talk a lot about today is going to be about planning, making sure you have a plan in place. Now, when I'm talking about planning, I'm not necessarily talking about going to meet with your financial advisor, getting a binder that's, yay thick, going over all these rates of returns and Sharpe ratios and standard deviation and all these techie terms when it comes to financial planning, and then taking that and putting it on the bookshelf behind you in the office and forgetting all about it. Because when it comes to planning, things are fluid. Our lives are constantly changing. What if we decide after a year or two of retirement, we can't take these brutal Chicago winters anymore and we want to move someplace warm? Well, that's a new thing in retirement. What if one of our children have to move home? What if we have to be a caretaker for a parent or a loved one? all of these different variables can come into play. So it's important to get your financial plan in place. By having this plan in place and then again reviewing it regularly, okay, and when I say regularly, I'm talking about at a minimum once a year, but probably a couple of times a year, and it'll help us to make sure that we are on track for retirement, that even though we experience these different variables that come in, these different changes in our life, we are still able to adapt and move forward with our retirement with confidence. So one of the most important things again about having the plan is taking this concern off of the table altogether. Okay, so how do we go about doing that? Well, let's talk about how where retirement came from to begin with. Okay, and the godfather of retirement, Otto von Bismarck, invented this term retirement back in 1890. As you can see, the difference between 1890 and 2021, our ages are a little bit different. Our life expectancies are significantly different, and but our retirement age hasn't changed that much. Okay, kind of the funny thing about this slide is showing that people really didn't get to retirement back in 1890 because they didn't live that long. Okay, if you were able to live until your late 80s, that is when you hit retirement. But retirement mostly came about at that point because you were unable to perform any of the job tasks. Now, hopefully, our goal in 2024 is that going forward, we're looking at trying to retire at a point where we still are able and capable and healthy enough to do all these things in retirement that we have been putting off for the last 30 or 40 years while we've been working. Okay. It's not a surprise to anybody here, hopefully, that we are all living a lot longer. So if we plan on being around a lot longer, we're not planning for 10 and 15-year retirements. When people come into my office and I talk to them, we're planning for 20 and 30-year retirements now. So that money that we save has to stretch a lot longer. Okay. So I'm not planning for somebody to live till 80. I'm planning for somebody to live till 90, 95, even 100 at this point. So those are things to take into consideration and just kind of show you how the idea or the concept of retirement has changed as a whole. Now, retirement has changed for this current generation from generations previously for a lot of different reasons. Okay. Your parents, your grandparents, maybe they were able to retire earlier. Maybe it was their mid or late 50s, early 60s, things like that. A lot of that was based on that's because employers were providing pensions at that time. Now, for a lot of us, pensions are a thing of the past. All right. Back when ERISA was signed into law in the late 70s, the onus was put on the employee to do the savings for retirement. That's where we got 401ks. That's where 403bs, IRAs, later Roth IRAs came into play. We have the onus now to save all this money. At the time, people were excited about it because they got to control the money. They didn't leave the investment responsibilities up to the company. They were able to maintain that and take that task on. But with that means the onus for retirement also fell on each individual person. So now we see people retiring a little bit later than the generation previous to that. Also, again, one of the things that we have to take into consideration is we are living a lot longer. I remember when I was growing up, if I saw somebody they're 70, 75 years old, man, they were old. Okay. It's not the case anymore. Now, if we find out, heaven forbid somebody passes away at the age of 70 or 75, we all look around, oh, that's so young. What was going on? And that's just the way that it's changed. We're all living a lot longer. Now, one of the big things to consider when we start to do our planning for retirement, and what I call one of the biggest barrier to entries for retirement, is how are we going to pay for our health care? Okay. So, one of the biggest things to take into consideration is that Medicare, which is retirement health care for anybody that reaches the age of 65, it does not kick in until age 65. So, when we're doing our planning for retirement, we're seeing most people or a lot of people have to wait until at least that age 65 point. Okay. That seems to be the age of demarcation for retirement. Now, maybe your company offers you some sort of retirement healthcare plan. That's something to take into consideration. Maybe your spouse is going to continue to work and carry the health insurance, which would allow you to retire before age 65. There's all sorts of, again, different variables that come into play. But for a lot of people, age 65 seems to be a magic number because of this health insurance uh, need that we'll have. Now, a couple of things to consider. We do have other options. We have the Affordable Care Act. Anybody is entitled to go out and try and get health insurance on the exchange. But if anybody has spent any time on there or has talked to anybody that is currently being covered this way, we know that this coverage could be extremely costly. So, for example, a 64-year-old that goes out onto the exchange, they could potentially be paying anywhere between $1,200 and $1,500 a month per person for health insurance. So if we're talking about a married couple, we're talking about almost $3,000 just in health insurance coverage. So again, that's something that needs to be accounted for when you're doing your retirement planning. Retirement planning isn't something that we just wake up and decide, oh, we're going to retire, next month. This should be something that we're planning for. Okay. When I work with clients, we like to plan 3 to 5 years in advance of retirement to make sure that we have all of our ducks in a row. So again, something to keep in mind when you're trying to choose at what age you're going to retire, healthcare being a major factor in this and how it's going to come into play for you. Now, one thing that people I've seen some people do is take into account age 63 and a half. Now, age 63 and a half sounds like a weird number. We're used to 59 and a half because of penalty-free withdrawals, but where does 63 and a half come in, Greg? Well, I'm sure you're all aware that if we were to lose our current employer's health insurance for whatever reason, whether we be laid off or we quit our job or whatever, we're entitled to 18 months of COBRA. So age 63 and a half, that gives us 18 months to bridge us to age 65. Now, we all know, if anybody's ever experienced it, that COBRA is also not cheap, but at least we know it's a known cost. We know what type of plan we have. We know what we can expect to pay with COBRA. So it is something that we could factor into our retirement planning if healthcare is going to be an obstacle that we need to cover if we're retiring pre-65. So these are all some things that we need to take into account when it comes to our retirement planning needs. Now, again, trying to determine what age to retire at, there is no magic number. I just stress that 65 seems to be a good number for a lot of people right now because of uh, healthcare. But for some people, they don't have to worry about that. So they like the age of 62 because that's the earliest that they could claim Social Security. Some people like the age of 70 because that's when they max out their Social Security and they've achieved the highest possible balance in there. So trying to determine, what age is going to be most appropriate for you. Hopefully, you're not on this presentation this evening worrying about in that last bubble there, the 80 plus bracket. Okay. Hopefully you've done some planning, unless you truly enjoy working at 80 plus years old. But I've seen it before and it has been experienced, but not necessarily something that I would want to strive for. So just keep that in mind when we're choosing to see when we're going to retire. But the majority of us here, as illustrated, tend to fall in that 61 to 65 age range. Something else to take into consideration is if there's an age difference, if we're dealing with a married couple and there's any type of age difference, okay? When you first get married and you're 25 and 22 years old, it's not that big of a deal. But when we're talking about a couple in their 80s, and on average, women are going to live 6 years longer than men, well, then we have some actual planning to do. Because if that's the case, we're talking about 6 additional years after age 80 to continue to provide a level of income, to continue to provide a level of care. Because as we get into our 80s, we know we're going to require more care. So making sure that we have all our ducks in a row so that when one spouse does pass away, the surviving spouse is going to be well taken care of moving forward, but we won't have any major impacts to their lives upon the first death. So again, something to take into consideration. Now, here we have a list of some very important ages I think that we need to take into account when it comes to our retirement planning needs. Okay. And we'll start with age 50. And at age 50, that is when you are able to start contributing to what are called catch-up contributions to your 401ks, IRAs, 403bs, Roth IRAs. And what this means is you're allowed to contribute an additional amount each year above and beyond what the max was previously. So for 2024, the normal IRA contribution is going to be $7,000 with an additional $1,000 of catch-up contributions. Okay. Now, at age 55, this is a little known fact that a lot of people don't that didn't realize. If you are separate from service from your employer and you have a 401k or some sort of retirement plan with that employer, at age 55, you are allowed to start withdrawing from that employer plan without any penalties. For a lot of us, it's drilled into our brain that we're not allowed to take out of our retirement plans until age 59 and a half. Otherwise, we'll experience a 10% penalty. But again, the caveat being, if you separate from service and you have an employer plan, this is not your IRAs, this has to be a 401k or a 403b, some sort of employer sponsored plan, then you are allowed to make withdrawals from that without any penalties. You will still have to pay income tax on those distributions, but there will not be any penalties on those withdrawals. So for those of us that are thinking about retiring early, are afraid to take from our retirement plans because we don't want to incur that 10% penalty, this could be a strategy that we use to help bridge that gap for a few years. Again, I mentioned 59 and a half is the age at which you qualify to withdraw from any retirement plan without any penalties. At age 60 is when somebody who has lost a spouse is entitled to start claiming widow or widower benefits from Social Security. Age 62 is the earliest at which you can claim Social Security benefits. But let me stress this, if you claim benefits at age 62, your benefits are going to be greatly reduced, anywhere from 25 to about 30% of what you would receive at your full retirement age. So not a decision to take lightly, again, something that needs to be planned for. As we hit age 65, that's the magic number for Medicare. I've already kind of touched on that today. But what I say if you're retiring at age 65, or if you are already retired before age 65, you should really start to get your Medicare application in 3 months before you actually turn 65. Okay. So again, here we are in January of 2024. Anybody whose birthday is that's going to turn 65 in April of 2024 should be getting their Medicare applications in now. Make sure you enroll in Part A, Part B, your Medicare supplement, your prescription drug plan. Decide which route you're going to take and make sure that's all lined up so that things go off without a hitch as you enter that month in which you turn 65 and you can really start to sail through retirement. Ages 66 or 67, those are the years in which you will reach full retirement age for Social Security. Okay. That means your benefits will no longer be reduced if you claim. Age 70 is when you maximize your Social Security benefits. So I mentioned at age 62, you will have reduced benefit. For each year that you claim Social Security before your full retirement age, your benefit is reduced 6.5% per year. Now, for each year that you delay your benefits past full retirement age until age 70, your benefit goes up by 8% per year. Okay. So there really is a good incentive to try and delay benefits if appropriate, to try and maximize that Social Security benefit check that you're going to get each month so you can have the most amount of income possible coming in. All right. This is something to take into consideration. Again, I'm going back to the previous slide, especially if we have an age difference between spouses, to make sure that when one spouse passes away, we're leaving the surviving spouse with the highest possible Social Security benefit. Now, I can spend a whole hour talking on Social Security this evening, and we don't have time for that. But something that you really need to take into account when you're putting into your retirement plan. And our last current important age is age 73. And age 73 is when you must begin taking your required minimum distributions. Now, for those that are not familiar, a required minimum distribution is a distribution that the federal government mandates that you take beginning at age 73. So what they're saying is all that money that you let grow tax deferred. So your 401k, your IRA, 403b, any of your employer plans or tax deferred plans, if you have not taken any distributions, or if you are taking smaller distributions at age 73 and beyond, the government is going to mandate that you take at least a required minimum amount from those accounts. And the way to determine how your required minimum distribution is the IRS has a life expectancy divisor table that you use to make the calculations for your required minimum distributions. So it all is going to be based on what your account value is in that divisor, and that's when you have to start taking at least that amount out of your qualified plans. If you are taking beyond that, that's fine. No big deal. No harm, no foul. If you're 73 and you say, hey, I don't need this money. I don't want it. I don't want to be taxed on it. I'm going to leave it in there. Well, then there are some pretty stiff penalties that are involved for those that don't take required minimum distributions. Again, think of it as the government's way of saying, hey, we've allowed you to defer taxes on all this money for so long. It's now our turn to start collecting some tax revenue off that money, and we're going to make you take a required amount out each year. That's the purpose of the required minimum distribution. So, again, something to keep in mind and not to ignore. Are there any questions up until this point on anything that we've talked about thus far?
I don't see any questions yet, but that's a great reminder for people that if something comes up, please go ahead and type that into the Q&A. But I think at this point, we can keep going.
Fantastic. Now, most people, especially when I give these presentations, everybody wants to talk about investments. Investments are sexy, right? Everybody wants to know what's the hot stock, what's the best fund to be in, how should I build a portfolio? And don't get me wrong, investments are important. Money is what drives the train when it comes to retirement planning. But there's so many different areas of retirement planning that need to be accounted for in addition to investments. So, as I mentioned before, your estate planning, tax planning, your risk management, health insurance, long-term care needs. Okay. All these different areas need to be accounted for in addition to our investment planning. And the thing that I try to stress most, okay, to everybody that I meet with, especially when I talk to young people, is it's not about what you invest in, it's more about the actual behavior of saving money and just getting the money into an account, okay? I encourage everybody to have a diversified portfolio, but really, it's not important to go out there and try and find, hey, what's the hot stock that I should be investing in? What asset class is going to perform the best this year? Because what I'm trying to illustrate on this slide is by trying to chase returns or time the market, ultimately we're going to fall behind. Okay. So I'm not encouraging everybody here to just put all of your money in the S&P 500. I'm just purely using the index as an example. But the difference between the index, which is a stagnant, okay, it's a stagnant group of stocks that you just pour money into and you don't touch it, versus an investor that's trying to buy and sell and trade to get the best case returns. You're going to see here that ultimately we're probably going to lag over the long run. Right. So again, going into making sure we have the mindset that's more important to actually save than to pick the right investments. So the term investments work, investors don't overthink it. Just get in the habit of saving, okay? And do the best you can. A diversified portfolio is not going to disappoint you. Are you with a diversified portfolio? Are you ever going to have the highest return possible? No. Are you ever going to have the lowest return? Also, no. And we'll illustrate that here in a couple of minutes. So, outperformance of the stock market is not a financial goal. Okay. If you meet with financial advisors and they pound their hands on the desk or the table and say, our goal is to outperform the market each year. What is the purpose of that? Why are we trying to outperform the market each year? When I work with clients, when we're putting together their plan, we're trying to determine how much they need to earn in their portfolio each year. Why would I invest somebody in an aggressive portfolio trying to achieve a 15 or a 20% rate of return when all they really need to do is get 6 or 7%? Why would we take on more risk and put their financial plan in jeopardy when it's not necessary? So building the right portfolio, again, in a diversified manner so that you can hit all of your financial goals. And again, it's something that needs to be reviewed and monitored on a regular basis. So stop trying to outperform the market. Sure, there's going to be years when we hit home runs, but I'm trying to hit singles, doubles, and triples more than I'm trying to hit home runs to make sure that we can ensure that we have a safe retirement. And going back to our very first slide, we don't run out of money. So I don't know if anybody's ever seen this before, but this is what's called a Callan chart. And with the Callan chart here is I'm trying to represent all the different asset classes that are available. And what I try to illustrate here is by looking at it, and this goes all the way back to 2022, we don't have 23 numbers yet, is only one instance here did one asset class repeat in back-to-back years as the best asset class, and that was the value asset class in 2013 and 14. Otherwise, everything is all over the board here. So if you invested in 2016 and said, "Hey, I want small cap was the best. I'm going to move for 2017. I'm going to move everything to small cap." Well, look what happens. You have the second worst performing asset class versus if you would have had a diversified portfolio. So again, what I'm trying to illustrate is to make sure that we don't chase returns. We don't chase the hot, sexy stock, chase the hot, sexy asset class, and build ourselves a diversified portfolio. Because as you see here, and this is illustrating a 60-40 portfolio, 60-40 portfolio is never going to be the best, but as I mentioned, it's also not going to ever be the worst. Okay. It is just a nice and steady path to make sure that we can protect ourselves and grow our money, because that's ultimately what we're trying to do, grow our money in retirement so that we can live a comfortable, stress-free retirement. So again, what I'm trying to illustrate here is this doesn't have to do with timing of the market. So if you're trying to be a market timer, chances of you being successful is not very great. What this is going to show is time in the market. Okay. Again, over long periods of time, we are going to end up positive. If you're trying to trade the market or time the market, the chances of your success are not great. So that's what we need to take into account here. It's time in the market, not timing of the market. Now, we all have experiences, and for the most of us that are using 401ks and IRAs, we know that we are just consistently investing in our accounts on a regular basis through our payroll deductions or however it is. We're dollar cost averaging, and that's going to serve us well. When the market is up, okay, we're investing in an up market, we're buying fewer shares. When the market is down, we're still investing the same amount, but we're buying more shares of these funds that we like so that when the market does recover, our account will recover exponentially faster. So something to keep in mind. Again, not timing of the market, it's time in the market. So the next thing that I want to kind of talk about are different investment products. Okay. And for most of us here, we know all these different, but I think it's important to review them, especially in the changing economic environment that we're experiencing now. Some of these have come more into vogue again, as they've been sitting on the sidelines for the last, 7 or 10 years. So just a quick thought on what these different products are and how they might be appropriate for you. And the first is we're all using them, bank products, right? We all have a checking account, a savings account, a money market. But what about a certificate of deposit? CD rates have been so low for so long, they've really been an afterthought for the last decade or so. But now with interest rates going up over the last 12 or 18 months, it's actually become quite attractive again. When you're seeing CD rates at, 5% plus, it becomes it'll make you think about using it again as a savings vehicle. Now, do we expect interest rates to stay this high for much longer? There's some debate in that. Okay, we can talk about what the Fed is going to do, but we can't predict the future. So why not take advantage of some of these different savings vehicles that are available? Now, one thing that I don't understand as a financial advisor, and I see it time and time again, is the loyalty that we have to these big banks, the Chases of the world, Fifth Third, Bank of America, where we put all of this money that we have in checking and savings accounts. They're not willing to pay us any interest for our loyalty. Okay. When I'm seeing savings account under 1% at the big boys banks, but I can easily go to Google or bankrate.com and find a very reputable bank that is in good financial health and see them paying in the excess of 4 or 5% for savings accounts. Why am I staying so loyal to these big guys? Just because there's a cash machine or ATM on every corner? Well, I'm not saying that we pull all of our money out of there, but I probably wouldn't do much of my savings in there. I would put my savings in something that's going to pay me a little bit more return on my money. Okay. Again, make sure that I'm within the FDIC limits. Make sure that the bank that I'm going to is in good financial standing. There's all easy ways to determine all of that. But let's not be loyal to these big guys and have have them not pay us anything. Because guess what? They're earning that extra interest. They're deciding not to give it to you. They're putting it in their own pockets. Okay. So let's be a little bit more judicious on our banks and use multiple banks. There's nothing wrong with that. We live in an online society now. So how long does it take to check a bank account on our computer or our smartphone? Now, we all know that when we're investing, the most common forms are stocks and bonds. All right. Stocks are a little bit more aggressive, a little bit more volatile. But what we're doing is we're purchasing ownership of a company. So if I buy a share of Apple stock, I own Apple. Now, they're not going to listen to me when it comes to voting. That's why they have a board of directors. I can't go in there and put my feet up on a desk. But that's what common stock is. It's going to represent ownership in a company. With ownership, if anybody on this is a business owner, comes risk. Okay. So stocks are typically more risky, more volatile than fixed income or bonds, which brings us to bonds. When we are purchasing a bond, what we're actually doing is lending a company money. Okay. So if I'm purchasing a 30-year bond from, let's call it Tesla, okay, I am lending them money. I'm going to lend them $1,000. They're going to they're going to pay me a stated coupon rate or stated interest rate for the next 30 years. And then after the 30 years, they're going to return to me my $1,000. That's the way that a bond works. Now, that's not to say that if you buy an individual bond, that you have to hold it for 30 years, because we know that bond prices fluctuate. Bonds have actually been beat up quite a bit over the last 2 years. With interest rates rising, bond prices are falling. So people are losing money if they buy and sell bonds. However, no matter what the bond price is, if you hold that bond to maturity, they will always return to you what your par value is. So if you're owning individual bonds, you'll see the price fluctuation. If you're owning bond mutual funds, that's when you'll see some significant price fluctuation in there as well. And it's a little bit harder to tell what is going on within those. So, again, bonds are fixed income. They're going to pay you a stated interest rate, and they're typically less volatile than stocks. Now, there are more volatile bonds out there. If you go into high yield bonds or junk bonds. Okay. So that means you're buying bonds from a company that is less than reputable. Okay. So there might be bankruptcy risk, which case, if they go bankrupt, they may not be able to return the par value of the bond. So these are all things to take into consideration when you're trying to decide what's your mixture of stocks and bonds, equities and fixed income. Another investment vehicle would be a fixed annuity. Okay. Again, a fixed annuity has become more attractive over the last couple of years because of interest rates going up. Now, I've seen fixed annuity rates start to eclipse the 6% range. That's something I never thought I'd ever see again in my career, but it's what's going on right now in today's environment. So I've had a lot of clients ask me about fixed annuities and to see if they're appropriate to get those higher interest rates. And we have to refer back to their plan and we make that determination. Now, those are the plain Jane fixed annuities where they almost work like a certificate of deposit. They're going to pay you a stated interest rate for a stated period of time. And then after that stated period of time, you have some options to walk away with your money, to reinvest the money, or move it to another company. There's also some more complicated fixed annuities. Those are the equity indexed annuities, and those have a lot of moving parts. And I'm sure some people on today's webinar have gotten some invitations in the mail to go to different dinner seminars and workshops where they talk a lot about annuities, and in particular, the fixed index annuities. And what I try to say is before you make any decisions to purchase any investment products, you have to make sure that you clearly understand what you're purchasing. There's a lot of sizzle out there. There's a lot of opportunity out there to make a product seem attractive, and then they don't perform the way they are sold. So before you make any investment decisions, make sure you thoroughly vet the product and make sure you understand all the different moving parts that might go along with it. With these equity index annuities, we have participation rates, we have earnings cap limits, we have asset fees, surrender charges, living benefits. There's a lot of different moving parts that you need to take into account before you invest in them. So just because somebody gives you a nice chicken dinner or steak dinner over at the Cooper's Hawk on Butterfield Road doesn't necessarily mean that you should invest in their products that they're talking about that evening. Make sure you properly vest any investment vehicles before you put your hard-earned money into them. Now, the contrary to a fixed annuity would be a variable annuity. Okay. And a variable annuity is just that. It's variable. It goes up and down. It is tied to the market. So think of a variable annuity as an investment in mutual funds with an annuity wrapper slapped on there. Now, the key with the variable annuities is they also come with some sizzle, guaranteed minimum income benefits, guaranteed minimum death benefits, guaranteed minimum withdrawal benefits, things like that. But they are also can tend to be very, very expensive. Okay. It's not uncommon to see a variable annuity eclipse the 4% range in fees alone. So 4% to hold that product is very expensive. What does that mean? That means you have to earn in the variable investments over 4% just to break even. Okay. So something to take into account. Any of these products that I'm talking about here, when used appropriately, can be a good vehicle. Okay. I am not on the end of the spectrum. We have the Ken Fishers of the world, the guy that says we do better when you do better, that says absolutely nobody should own an annuity. Then we have the other guys in the world that says everybody should own an annuity. And where I say the truth probably lies somewhere in the middle. Okay. Just like any investment, when used appropriately in the right situations for the right circumstances, it is proper to consider using an annuity or consider buying a stock or a mutual fund. Okay. So making sure that we truly understand what we're purchasing before we do it, and then the reason that we're purchasing it. If we're buying an annuity to make sure that we have income in the now or in the future, then that might be appropriate for you. If you're buying an annuity just so you can try and beat the market, well, maybe you should consider some other vehicles. Another product that we have are alternative or more complex products. And what we're talking about with these products are something like a real estate investment trust, business development corporation, a 1031 exchange, or a tip, something like that. Okay. And something that usually provides very illiquid investments, meaning that if we're going to put our money in there, that we're going to have to wait for a long period of time, typically 10 years plus, to get any type of return of our money. Now, in contrary to that, they're typically going to offer you a higher than average dividend or interest rate to entice you to invest in those. And again, these aren't bad products when used appropriately, but this is something that I would never invest more than five, maybe at a max 10% of my overall portfolio in. Okay. Again, typically these products are very illiquid. They are risky. They are more complex. So again, make sure you have a true understanding in what you're investing in. And then again, the purpose for which you're investing in it. Next, we have mutual funds and ETFs or exchange traded funds. Okay. A mutual fund, we're all pretty familiar with. If we're investing in 401ks, we're purchasing mutual funds. Okay. Exchange traded funds, they have become more regular. So, again, a mutual fund is a collection of stocks or bonds. Okay. And they provide a certain investment strategy. Now, we might be buying a large cap growth fund, a small cap value, a mid cap fund, commodities fund. But before we buy any mutual fund, it's important for you to do some research, because just because we're buying the large cap value doesn't necessarily mean that all the investments in that fund are large cap value. We have to look at the prospectus. By digging into the prospectus or the fund fact, you might learn that that fund manager only has to invest 60% of the money in large cap value. The remaining 40% can be invested in mid cap or fixed income or whatever. So, what's important is just because a mutual fund is called something doesn't mean that's necessarily how it's fully invested. What a mutual fund is called means nothing. What a mutual fund actually does means everything. Now, in ETF, we use ETFs to represent the index. Okay, so there's an ETF for the S&P 500, for the Dow Jones Industrial, the Nasdaq, the Russell 2000. We also use it to represent some commodities: oil, natural gas, copper, gold. It's like that. Now, mutual funds, their price does not fluctuate throughout the day. They have an opening price and then a closing price. ETF is similar to a stock where its price fluctuates throughout the day, depending on how much is bought and sold. So, something to keep in mind. Something one of the other differentiating factors between mutual funds and ETFs are the internal fund expenses. Okay, depending on what mutual fund you're buying from what mutual fund company, it's going to have an expense. Okay, and a mutual fund expense is typically more expensive than an ETF. So more people have been gravitating towards ETFs. Another reason that we might gravitate towards ETFs versus mutual funds is for tax planning purposes. We don't have a lot of control over what is bought and sold within the mutual fund. So there could be what we call phantom capital gains that are generated throughout the year. If anybody here has owned a mutual fund outside of a qualified plan, you might get a 1099 at the end of the year for capital gains. And you think to yourself, you scratch your head, hey, why did I have capital gains? I didn't buy or sell this fund. Well, it's the internal buying and selling of the funds that generates the capital gains. Now, when we have an ETF is similar to a stock. We only have capital gains when we sell the ETF. Okay. So there are no unwanted or unknown capital gains coming our way when you have an ETF. So they're good uses for tax management tools. Now, managed account. Managed account is when you're working with an investment advisor, financial planner, portfolio manager, whatever you want to call them, whatever term you're comfortable with. And then they're building you a portfolio. They're building you a diversified portfolio using some or all of the different investments we just talked about: stocks, bonds, mutual funds, ETFs, alternatives. Annuities, fixed annuities, and variable. Okay, using all these different investment products to hopefully build you an account to help meet your retirement goal needs. Okay, this is how we use managed accounts. Now, typically with a managed account, there's going to be some management fees involved, and make sure those are disclosed to you up front. All right. Any advisor that you're working with that does not disclose their fees, that is not transparent about their fees, is somebody you should run from. Okay. Transparency is key. Everything has a cost. It's up to you to determine if that cost and the value that you're receiving is appropriate. Which brings me to my next slide of understanding fees. Okay. Everything has a fee. You've all heard the term, there are no free lunches, right? So everything has a fee. There's all sorts of different fees that we could encounter. If we are buying a mutual fund on our own, chances are we're going to buy an A share mutual fund. So if I'm going to invest $100,000 into XYZ mutual fund, they're going to have an upfront fee. And that upfront fee could be anywhere between 2 and 5%. So if I give them $100,000, they invest in the fund for me. That means on day one, I'm starting with $95,000. And from there, it's going to grow. Okay. Now, why would I ever want to invest in something that's going to charge me 5% upfront? Well, with that, you see my third one down on the list is what's called a side load or level load. All these funds have internal expenses as well. So by paying the upfront fee, we're going to have a much, much, much smaller internal expense than if we were to not pay the upfront fee and go with the side load or level load, which on the average is anywhere between 1 and 1.25% when it comes to side or level loads. So those are two of the most familiar mutual fund expenses. Again, this is mostly if you're working on your own. If you're working with an advisor, they have access to much lower expense ratios as well. Something to take into mind is a back end loan. So any of those annuity products that we talked about, they have what's called back end loans or surrender charges. And what that means, and these numbers are just for an example, if I invested $100,000 into an annuity and it was a 5-year product, that means if I tried to get my money out before all 5 years are up, I am going to have to pay a back end loan. So in this example, if I tried to get my money out in year 3, I'm going to have to pay a 4% penalty to get my money back. Now, a lot of these companies have free withdrawal provisions up to a certain amount, which will allow you access to that. But that is why it's important that before you make any determination on whether or not to invest in a product that has a back end load, you make sure you have enough liquidity to sustain that surrender charge period should you need it. Okay, so that's what a back end load is. 12B1 fee. A 12B1 fee is an internal marketing expense used on mutual funds to help produce those beautiful color brochures that you see all over the place. Commission-based accounts, these are kind of fading into the sunset at this point. But if anybody here remembers the movie Wall Street and Bud Fox, or any of those trading movies where if you place a trade for a stock, they're earning a commission off of it. Or even now, if you have an account with E-Trade or Charles Schwab, where you go in there and make trades and they charge you $7.95 for a trade or whatever that is, that's a commission-based account. These last three, fee-based, advisory fee, or management fee, are kind of one and the same. That's where, if we go back to our managed portfolio here, where you're working with an advisor, or maybe you're working with a robo-advisor, they're going to charge you a set annual fee. That fee is taken out maybe on a quarterly basis, monthly basis, depending on how it's set up. And that could be anywhere from, 0.5% up to 2.5%. Again, make sure you know what your fees are, and again, what value you're getting for those fees. Are there any questions on anything we've talked about thus far before we get into our income distribution conversation?
I don't think so, but just to maybe prime the pump, just a moment. I know you've been talking about a lot of different investment options. But just if we're looking for an alternative to those savings accounts, can you suggest anything that maybe would give slightly more interest than a savings account, but still be quite liquid?
Barry, I can give you a ton of ideas. Okay. The resource that I use is I go to bankrate.com. And if we're comfortable with it, you have to embrace these online banks. And I'm not suggesting any of the banks, but some of the big ones out there. Ally Bank, Discover, okay, Capital One. All of these banks have high yield savings accounts. So they're still extremely liquid, meaning 100% liquid, but they're paying in the 4 to 4.5. I've seen up to 5% on a savings account, as opposed to the JP Morgan Chase, the Bank of America that are barely paying 1%. So those are some, and they're all FDIC insured. They're all extremely safe. The reason that they offer those higher rates is they don't have the brick and mortar. So as long as you're comfortable making online transactions and they can transfer back and forth between your current bank, it's very easy to do. You can get yourself a much higher rate of return on those accounts. To me, it's it's almost criminal to leave all this money in the big banks when there's so many other options that are available. Does
Sounds
that
good.
answer your question?
It sure does. Thank you. Again,
Yeah.
uh, I don't see any other questions that have come in, but just, if someone has a question, probably others in the webinar do as well. So please don't hesitate. Oh, someone is asking, can you spell that online rating site? Is it bankrate.com, like
That's it.
BANKRA? That's it?
That's
Okay,
it. Bankrate.com.
great. Okay, why don't you go ahead and people can continue to enter their questions as they think of them.
Okay, so now we're going to get into a couple of different income strategies. Okay, and these are two separate income strategies that I'm going to talk about. I'm going to talk about a guardrail income strategy, and I'm also going to talk about a bucket income strategy. Now, I'm going to talk about them separately, but in reality, they can be used congruently together as well. So I just want to make sure that that's clear before I get started. But when I'm talking about guardrails, what I'm trying to do, if you guys think of guardrails on a highway, they're trying to keep us safe. They're trying to keep us in the road. So what I'm trying to do is offset the risk of early poor performance in retirement. Worst thing that could happen, if anybody knows anybody that retired in 2008, 2009, you retire that year and your portfolio immediately loses 20, 30, 40%. And you think, oh my God, how am I going to sustain this? You had already done your planning of, hey, I know I need $4,000 a month to live off of. But if your portfolio was $1 million and you're down 30%, now you're taking 4,000 a month from 700,000 instead of 4,000 a month from $1 million. How quickly are we going to go through that? Much quicker than we expected. But if we have a very disciplined approach in place that will adjust our income both up when the market does well and down when it does poorly, then we can properly sustain our levels of income in retirement so we do not have to overcorrect or overreact to losses in portfolios. So part of what I'm trying to do with the guardrails is emphasize small incremental changes over time. Okay. And then again, this can be implemented at any time. It's not for anybody just entering retirement. If you are already retired, then we can do that. Even if it's before you retire, I try to get people used to the guardrails a year or two in advance, just to get used to living how you would in retirement. So it's a good exercise to explore. But one of the things that we're looking at here, and this is a chart on how we do that. So in this example, I have somebody that's looking for $9,000 a month. That's what they have in expenses. Okay, those are their fixed expenses. And based on their portfolio, okay, they can safely take out 11,100 a month. Okay, they have a portfolio of 2,224,000. So they're exceeding what they need in retirement for their fixed expenses. Okay, so they have a little bit of a slush fund. Now, what we're illustrating here is if their portfolio goes up just slightly, okay, goes up $110,000, we're going to give them a raise of $400 a month. Not bad. However, if their portfolio were to decrease, and if it were to go from 2,224,000 down to 1.5 million, so a $700,000 drop, well, that's when the guardrail is going to come into play, and that's when we're going to reduce their income. But if you notice here, even though it was a dramatic drop, a pretty significant drop, we're only going to reduce their income $500 a month. Okay, they're going to go from 11,100 down to 10,600. And if you can see here, that 10,600 is still in excess of what their retirement expenses are. So they're still going to be in good shape when it comes to that. Now, something to keep in mind here, and this is where tax planning really comes into play, and it's essential that you take it into consideration. When it comes to our retirement income, what I want to do is fill up all my favorable tax brackets with pre-tax money. So my 10% bracket, my 12% bracket, my 20% bracket, my 22% bracket, I want to fill up with all of my IRA 401k distributions. Okay. Right now, we are in a very, very low income tax environment. And if I wasn't talking to you in person, I would ask you to raise your hand. Where do you think taxes are going to be in the future? Higher or lower? Well, I can tell you this with certainty. If there are no changes to our tax code in the next 24 months, in January of 2026, our income tax brackets are going to revert back to what they were before the Tax Cuts and Jobs Act of 2017. Okay, which means they are going to go higher. Now, I have no prediction on if that's the case. I have no idea if they plan on making any other changes, but if nothing is done, that's where we're going to end up. If we need more money beyond the 24 or the 22% tax bracket, that's when I start to dip into my non-qualified funds, my taxable brokerage accounts. That's where I try to manage my long-term capital gains. And what I'm trying to illustrate here is there's a lot of moving parts. So there's a lot of tax planning that comes into play. Excuse me. So it's not as simple as trying to get money from the closest. You really need to coordinate your withdrawals, develop a strategy to put yourself into a better tax situation. Now, depending on when you retire and depending on when you claim Social Security and then your required minimum distributions, those are what I call gap years. All right. That's when a lot of tax planning can come into play. Really focusing on trying to decrease my pre-tax money and either move it into a tax-free bucket, my Roth IRAs, or into a taxable account like a brokerage account or something along those lines. So tax planning is so essential when it comes to your retirement income planning so that you don't get stuck with unnecessary tax bills. On average, I'm seeing my clients spend over $1 million in taxes. If we could find a way to reduce that just a little bit, all of it falls to the bottom line for you. So you either get to spend more in retirement, leave more behind to whoever you love after you have passed away. So that is the guardrail approach, making sure that we have a clear road to drive on, but we're never going to stray too far so that our portfolio and our income is in jeopardy. Next is our bucket strategy. Okay. And number of buckets is not really relevant. There could be any number of buckets. Some people might only have 3 or 4. Some people might have 10 or 12. But what I use, I'm a man. Okay. I like to compartmentalize things. So bucket strategy really works for me when it comes to compartmentalizing. Okay, this is what this investment is used for and how I'm going to use it. All right. So that's what I use with the bucket. So one bucket that I have is going to be 12 to 24 months worth of living expenses. Again, to go along with the guardrail strategy, I want to protect myself in case we have a market downturn in those first couple of years of retirement. So if I have 12 to 24 months worth of living expenses in cash, meaning those high yield savings accounts that we just talked about, liquid investments, maybe certificates of deposit, um, high quality treasury notes, treasury bonds, things like that. Well, then I know that if the market were to see some volatility, I have enough money on hand to weather the storm for a couple of years, which will allow my longer term accounts the opportunity to recover in the future. So that's why I always suggest I always try to plan for 12 to 24 months of income in in my first bucket. After that, I'm looking at a little bit I'm looking at my fixed income, okay? 3 to 5 years. That's where I'm getting my fixed annuities, my bonds, fixed income, certificates of deposit that have a longer duration on there, okay? I'm putting those in another bucket to make sure that they're safe so that, again, if the market is um, acting volatile, I still have safe investments earning a reasonable rate of return, a stated interest rate, so that when I drain my 12 to 24 months worth of expenses, I can shift that bucket over and replenish. After 3 to 5, I'm looking at my 7 to 10 years. That's where I'm putting my equities, my mutual funds, ETFs, stocks. Okay. That's where I'm putting those. Those are my more volatile investments. They need a little bit more time to grow so they can weather any volatility that we might experience in the markets. Okay. Then we have another bucket for 10 plus years. That's where I might be putting those really complex or alternative products because, as I mentioned, they're very illiquid. So I'm going to put those in my furthest out bucket, again, allowing them to mature, but still paying me a decent rate of return as I wait. They pay me to wait. So that's just an example of how we can set up some different buckets. Again, people have used different buckets for different reasons. Maybe we want to use a bucket for charitable giving, and that's where we put our riskiest assets. Maybe we need to set up a bucket for bequest to our children. We want to make sure we leave this bucket behind to our kids. Okay. We didn't talk about what bucket real estate falls into. So there's all sorts of different buckets that we can have. But hopefully you can see that even though we're using this bucket strategy, it can still work with a guardrail approach on it as well. So, with everything that we've talked about, this would be a lot to go out and try and do on your own. So, what I want to do is try and provide you some resource on how you can vet some experts, how you can go out and search for an expert to help you navigate through all these different investments, all through your tax planning, through your income planning, okay, all these different areas. Okay, so how do we go about doing that? Well, one of the major issues we have with our industry is that anybody really can call themselves a financial advisor or a financial planner. Sure, we all go to school for different things. We have designations after our names, but there's no difference than the insurance guy that might sell a fixed annuity, okay, calling himself a financial advisor as opposed to a certified financial planner, okay, calling themselves a financial advisor. There's no way to differentiate between the two, okay? You would have to do your research on your own to determine that. So that's one of the things that it's important that when you are looking for somebody to work with, make sure that you're getting what you need from that person, that they're not limited, that they cannot meet your what you require to have a proper retirement plan in place. Any of these people listed on here can serve in that capacity. And again, it's important to find somebody that you first and foremost like and trust. Okay. Make sure that their fees are reasonable. If they tell you they have no fees, that they get paid by the companies they do business with, okay, that's something that you really need to take into account. Everybody should be transparent with their fees. All right. It's 2024 now. There's no reason to hide anything. So make sure that whoever you're working with is transparent. Now, another source that you can use to try and determine if the person that you're working with is capable and worthy of your business is to go through FINRA. And FINRA is the regulatory uh, community that they use to monitor financial advisors if you are securities licensed. So if you go to the FINRA website or you Google FINRA broker check, you can put in the name of your financial advisor that you're currently working with or the financial advisor you're thinking about working with, and you can check on them. You can see what licenses they hold. You can see what states they're licensed in. You can see if, most importantly, if they have any complaints or lawsuits or discretions or disclosures against them. Okay, let me say this: just because an advisor has a disclosure that might be negative on their record doesn't necessarily mean that they're a bad advisor. We live in a very litigious society right now, so people like to sue and do all sorts of things. It's important to read on the disclosure what happened, what was it for, and what was the end result. So just keep that in mind. But there's also some other good resources on the FINRA website, a fund analyzer, so you can look at uh, your different mutual funds and get some more information on there, an RMD calculator if you're having difficulties with that. So with that being said, that brings us to wrap up our presentation this evening. I know I went a couple of minutes over. I apologize on that. But I will open the floor to anybody that has any questions at this time. I also want to just point out, if anybody wanted a copy of this evening's slides, or if you wanted your own free retirement assessment, please reach out to me. Happy to send the slides over to you. There's no charge or anything. There's no commitment, anything like that. So with that being said, I will open the floor to any questions that might be out there.
Great, thank you so much, Greg. I don't know that there's another question right now. I'm just, I know you gave that FINRA website, just maybe any other pointers as we close about choosing an advisor that you have, maybe, talking to friends or any other suggestions that you have for finding a good financial advisor.
Yeah, you've got it right there, Barry. Start with your friends and your family, see who they're working with. But just because they're working with somebody, you really have to find somebody that honestly you truly like. Okay. You're hopefully this is going to be a long relationship, something that's going to last for the next 20 or 30 years through your retirement. So finding that person that you don't dread going to their office when you have to do your semi-annual reviews that you enjoy being around, I think is important to make sure that they're competent at the same time. We have enough friends in the world. Okay. I have enough friends in the world. I don't need another friend. I don't want to dread going to my doctor's office. I don't want to dread going to see, this certain professional that's going to be around for a long time. So talk to friends and family, attend educational events put on like this by the library, in the park districts and things like that. There's a lot of Google searches out there. There's websites like Wealth Tender and things like that that help give you more information to find an advisor that specializes in exactly what you're looking for, because not all things are created equal. So those are kind of my tips to finding the appropriate advisor for you.
Great, thank you. Someone is commenting that they'd like a class on how to withdraw funds because it's quite a large and complicated issue. So that's something that we will keep in mind perhaps for the future. Thank you. That's a great suggestion.
Yeah, let Barry know I have a tax course too, and that's what a lot of it is how do I get money out of these accounts that we have in the most tax favored way manageable. Right. More tax help. There we go.
Wow. Big topics.
Yeah.
Well, thank you so much for your time, Greg. At this point, we'll say that I do have a number of resources to send out following tonight's program in that email that I always send as a follow-up. If you're watching the recording of this program and would like those links and resources, just email me at ce@wheatonlibrary.org. That's CE for community engagement @wheatonlibrary.org. But with that, I think we'll say good night. Thank you again to our presenter and to all the folks that joined us tonight. Everybody stay safe and healthy, and we hope to see you again soon. Good night.
Thank you, everybody.